Hello, everyone. Thanks for joining in. We have Sandeep Walia with us, our expert, and he's going to talk about, I would say, a critical topic in supply chain, which is inventory management and how inventory management increases the cost of doing business and reduces the profitability. Of course, that's the bottom line everybody is looking for. So we'll wait for another maybe couple of minutes because people are joining in. In the meantime, please share in chat where are you joining in from, so that we see the community around us. And Dr. Mudassir and I always talk about how do we bring this community together in supply chain. There are supply chain professionals are everywhere, but they don't talk to each other. So we want to give you an opportunity to network basically in such sessions. So we have got Vienna, we have got Chicago joining in. We have got Mexico, we have got Dubai. We have got another Mexico. I am joining in, for instance, from Toronto. And yeah, Mexico, Paraguay. Wow.
Hello.
Hello, Mudassir, how are you?
I'm all right. I'm all right. Sorry for being late a bit. This is Mudassir from Dubai, along with Mr. Sandeep Sa. Sir, how are you?
Very good, Doctor. Very good, Dr. Mudassir. How are you?
I'm good. I'm good. We very busy day, but all good.
Awesome. So what we are doing, Mudassir, here, we are just asking everyone to share where are they joining in from. So far, we have Chicago, we have Vienna, we have Dubai, we have Mexico, we have Toronto, we have Paraguay, India, and we have more Chicago. You're joining in from Dubai. It's truly a global event, I would say. India.
It is mostly. Most of our webinars are global, right?
Yes, UK, Pakistan. Awesome. Yeah, please keep sharing because what we aim at SCM Dojo is to create an inclusive community of supply chain professionals who are learning and growing, because that's what is probably a bigger missing element in the whole scheme of supply chain. And Mudassir and I keep talking about it, that why companies are not really investing into the human resource development within the supply chain industry. We see very expensive conferences and people going for training programs and stuff in so many other disciplines. So for instance, marketing, for instance, manufacturing and all that. But how many more dollars are required to invest into supply chain, which actually is perhaps the most critical component of our business longevity and success going forward. Sitting in Canada, while people are still joining us, I can tell you, I booked a Toyota earlier this year, and they are still not sure when are they going to deliver it to me. So
Because it's a bad car. You should go for Tesla or something. Right.
Yeah.
So, Ahmad bhai, let me intervene slightly here. I know you got to finish 5 minutes before the plant time,
Yes.
right? So let's call it 7 p.m. Dubai time. I also know Sandeep Walia has a fantastic 30 to 40 minutes presentation. So we don't want to eat into his time. And the whole point is we want to give people opportunity to ask questions to Sandeep, right? That's the main bit. So because this is where we have Sandeep. And I don't think we have done the Sandeep intro. Sandeep, you have introduction slide or
No, I was planning to introduce him, very quickly.
Please.
Again, a fantastic leader in supply chain who has global vision. He has worked in France, Japan, Singapore, Germany, UAE, USA, and India. His focus has been in CGP, luxury goods retail supply. And he's a strategic consultant with tons of experience in multicultural environment, planning, project management, communication, and motivation. He is a visiting faculty for supply chain, SNOP, and IBP courses. With any further ado, and he's a great supporter of supply chain professionals and SCM, a good friend of SCM Dojo and Dr. Mudassir. So we can start. We have 32 people already in the room. People will join in. This session is being recorded. So those who are unable to join in can always watch this
Yeah,
session.
there's two important people excuses which I Arthur was sharing. The one from Patrick Long from USA, he was very interested to hear from Sandeep, and one is our friend Matthias, right, which is not here. So we are recording and we will be available. And I just want to say hello to Juan, right? He's in Mexico. He's just joined in. So Sandeep, over to you, Habibi. Take it away.
Thank you. Thank you, first of all, for giving me this opportunity, Hamad and Dr. Mudassir. And good morning, good afternoon, good evening to everyone, wherever you are. I have prepared, for the sake of discussion, I have prepared a few slides. So I'll just pull them up. Please let me know when you can see them.
You can see your slides.
Okay, cool. So what we plan to cover today is basically three things. First one is financial impact of inventory, why inventory is so important for businesses, especially in the current context, and how it impacts your income statement, your cash flow statement, your balance sheet. What are the different components of inventory that we need to take into account before we start thinking about inventory optimization? What can be the different techniques? And then I'll conclude very quickly. And then we can go over to question and answer sessions and more open discussion around this topic. Now, I wanted to start with this slide. So what you see here is the share price action of one of the biggest famous, well-known multinational corporations. So when they published their quarterly results end of September, their share price tanked by 10% in one day. And that 10% drop in share price was billions, tens of billions of dollars reduction in the market cap. Now, why it happened? Because they announced in their quarterly financial results, year-on-year increase of 4% in revenue, year-on-year decrease of 22% in net income, and year-on-year increase of 44% in inventory. Right. So this was the market reaction to these financials that were published by this company. And why market reacted it like this? Because inventory means you don't have the cash that you have stuck in the inventory now is the cash that you don't have for other top line initiatives, opening up new stores, launching new products, more marketing and branding initiatives. So it is the cash that you don't have available for something that will generate top line. And at the same time, to liquidate this excess inventory, you will have to take a hit on your margins because you will have to sell the merchandise at discounted price, right? So it is a double impact. And it is not only this company. If you go 2 or 3 weeks back, it is the quarterly earning reporting season. And there are a lot of retailers in North America and Western Europe. They are suffering from what the experts are calling inventory glut. And it is basically industry-wide phenomenon where in 2021, most of the CPG players and retailers, they were struggling for inventory. And in 2022, they have inventory problems, excess inventory problems. But this is not same everywhere. As Hamad mentioned, in automotive industry, due to different component shortages, we don't have the finished good inventory. And the lead times to get a car can stretch anywhere from 12 to 18 to 24 months. Now, why inventory is linked to the financial performance of the company? And you might have heard of supply chain triangle. Everybody talks about Bermuda Triangle, but I think supply chain triangle is even more mysterious one, because this is the job of everybody in every supply chain manager, director, to balance basically these three sides of triangle: service, working capital, and cost. Now, inventory is intrinsically linked with all three of these sides. Availability is nothing but inventory, and availability translates into a better service, better experience, and that basically translates into your top line revenue, right? Costs, most of your COGS that you incur, it is to move the inventory around: inbound, outbound, store to store transfers, DC to DC replenishments. So that is basically the cost that you incur to move the inventory around. And working capital, cash, is nothing but your level of inventory, the cash that is stuck in inventory, or that is put in inventory to generate sales. Now, if we look at in a simplified way, let's say service translates into revenue, and your revenue minus cost is your earnings before income tax. And once you pay your tax and take care of your depreciation amortization, you have your net income. And net income divided by your working capital is basically your return on capital employed. So what the financial community, your stakeholders, financial analysts, your investors or shareholders, they look at is it's your financial performance basically as a company, not only your top line, but also your bottom line, your earning per share, and all the financial ratios that go with it. And then they decide whether you are performing in the market or not. A simple way of looking at it, so that it is clear. Let's say a company has a sales of $400 and total costs of $340. That is coming from basically their COGS, their expenses, their taxes. So the net income at the end is $60, right? And they have total assets, so fixed assets, the cash they have in the bank account receivable, and inventory of 200. So if they have total assets of 400, where inventory, as you can see, is a very big component, then return on asset or return on capital employed is basically 60 by 400, which is 15%. So here you can see directly, if you increase or decrease the inventory, there is a direct impact on your return on asset that is basically monitored by the financial community. The objective is for any supply chain, if it is there to add value to the business, is to increase the net income by providing the availability, and at the same time increase the return on asset by decreasing the inventory. Right. So this is one of the components that explains the impact of inventory on financial performance of a company, and why it is so important, especially in the current context that we are living in. The second component that is very important for anybody in supply chain planning to understand is the notion of cash conversion cycle. So what do we mean by cash conversion cycle? It is a very famous supply chain metric, which basically explains the number of days you need to transform the cash that you have in inventory into cash that you have from sales. So this is what cash conversion cycle means. And it is calculated, there are different components that are used for calculation of cash conversion cycle. So here you see number one is inventory. So it's basically your days of inventory on hand, which is your inventory turns. So it's basically your average inventory divided by COGS multiplied by 365 to get it into days. Then is your then the second component is account receivable, and the third component is account payable. Optimizing inventories, and here it is very important to note the word optimizing. It is not reducing, right? It is optimizing inventories and aligning them with your business needs, basically helps your cash flow, right? And inventory that is sitting there in the warehouse, not supporting any sales, your excess inventories, your slow movers, your obsolete products, they are basically wasted capital. Reducing the payment terms to your clients downstream helps in generating cash. And similarly, increasing the payment terms to your suppliers also generates cash. And the way we measure cash conversion cycle is very simple. It's your days of inventory on hand plus your days of sales outstanding minus your days of payable outstanding. Now here, if we look at some numbers, let's say we generate 100,000 in sales and 50,000 is our COGS. We have an inventory of 16,000 to generate those 100,000 of sales, the accounts receivable of 12,000 and the account payable of 16,000. So in using this formula, we can say that the cash conversion cycle in this particular case is 44 days, right? Now, imagine a scenario where the inventory was 25,000, right? So our cash conversion cycle will be long. Or it was 12,000 to achieve the same amount of sales through optimization, then the cash conversion cycle will be shorter. So these, let's say, three components are very important: supply chain triangle and how inventory or your inventory planning impacts different sides of your supply chain triangle. The return on assets or return on capital employed, how low or high inventory impacts that financial metric, and then cash conversion cycle, how higher or lower inventory basically shortens or lengthens your cash conversion cycle. So I think I'll pause here if there are any questions. And for me, the important question will be today in your businesses, how many of you follow ROA and cash conversion cycle as a supply chain metric, so that you can have the understanding of impact of inventory on your financial performance.
So you want do you have more in your presentation, or is it complete?
No, it's I have more.
You have more, right? So why don't we complete the whole presentation and then break them into groups where they can come back and ask questions, if you agree.
Okay, perfect. I'll go through it quickly so that the teams, they have time to discuss, and then we can have an open discussion.
All right.
So the second part is what are the different components of inventory that we need to understand as supply chain, so that we can know where the optimization opportunities they sit. So the first thing is to understand how my inventory is structured. And there are different components. Cycle stock, as you can know, is the first dimension. So it is basically something, it is the inventory that is linked with your lead times or with your batch sizes. Safety stock is on top of your cycle stock. So it is linked with your supplier reliability and demand uncertainty. So to cover the variations in demand and to cover the variations in supply reliability, we have safety stock. Now, then we have anticipation stock. Sometimes outside of cycle and safety stock, we need to anticipate certain events. So in the region here, Ramadan is a very important event, and to be ready for Ramadan, businesses, they prepone the inventory or anticipate the inventory 3-4 weeks in advance. Christmas in North America and Western Europe is very important. Then you have all the other events across the world that can have this need of anticipating. For example, now Qatar World Cup is going on here in the region, and all the retailers and businesses in Dubai, they kind of jacked up their stock because of the increased footfall or increased number of visitors. Then you have the in-transit or pipeline stock, which is for international businesses, the in-transit that is in the ships or in the air cargo. And the last dimension is the strategic stock. So sometimes companies, they have to carry the inventory of raw materials or components or finished goods because they want to hedge against the increase in the prices. So if you are, let's say, a luxury watchmaker in Switzerland, and you are one major part of your business comes from gold, platinum, titanium, diamond watches, then you need to have strategic stocks to cover for any change in the commodity pricing moving forward. Similarly, in pharmaceuticals, pharmaceutical industry, there are local guidelines where certain drugs have to have a minimum level of stock. especially for strategic drugs or strategic medicines, then this is where this component comes in. Now, on top of it, there may be MOQs, SLAs, distribution agreements that can have an impact on inventory. And if you are in retail business, then the inventory that you need for display, the presentation stock or display stock, becomes part of the inventory as well. Now, what is important for supply chain professionals to understand here is, if I have $10 million at the end of the month in inventory, what part of that 10 million is cycle stock? What part is safety stock? In transit is easy, anticipation is easy, and what part of it is basically strategic stock? Because if we split the stock holding or stock value into different components, then we can find the actions. That are appropriate to reduce the inventory or optimize the inventory, right? The second component is the classes. So we might have raw materials and components if you are into manufacturing and distribution business, or WIP categories, that is your work in progress, your finished goods, the inventories in distribution channel, the damaged, obsolete, blocked inventories, the collaterals. What do we mean by collaterals? So when let's say you are a retailer and you are selling a finished good, you need bags, you need gift boxes, you need wraps, ribbons. So this is basically what we call collateral inventory. And it might come as a surprise to you. In most of the businesses, collaterals is nobody's responsibility. And sometimes collaterals can be in millions of dollars, and it can be also an inventory optimization opportunities. Because if your monthly consumption is, let's say, 1,000 gift boxes or 1,000 bags, and you're ordering 4 months of inventory, whereas lead time is 1.5 months, then basically you are blocking extra cash in the inventory that you don't need, right? So understanding if you are an end-to-end business with raw material, WIPs, finished goods, and collaterals, what is the makeup of my inventory across different classes? The third component is have a clear understanding of inventory cost structure. So everybody knows about the unit cost, but then on top of unit cost, there are other costs to have in mind. Ordering cost. Every time I'm sending POs or I'm managing the back orders, there is a cost related to it. The cost of the salaries of the team, the extra work that they have to do, the systems that are in place. Carrying cost is basically your storage cost, warehousing cost, handling cost. Transport is to move the product from A to B if it is inbound, or B to C if it is outbound. And then on top, out of stock cost. What is the lost sales due to lack of inventory or out of stock, because we don't have the right inventory at right place, right? So this also becomes very important in terms of inventory optimization, and you'll see it why when we'll discuss in one of the techniques. Now, what can be, once we understand the financial impact of inventory, different components of inventory that we need to take into account, or at least have an understanding of, we can discuss about some of the inventory optimization techniques. Now, there is a lot of literature, documentation on internet on inventory optimization. Setting up your reorder points, trigger points, push-driven, pull-driven, peak strategy, chase strategy. So there is a lot of documentation, but I wanted to cover something that is relatively simple, easy to implement, and where you can basically grab the low-hanging fruit with little effort. So the first one is product segmentation. Everybody knows about ABC, XYZ analysis. We do it in the businesses, in the supply chain all the time. But what is very important is taking the next step, which means define differentiated supply chain strategy based on the product segmentation that has a direct impact on your inventory holding. So if here you see the 2x2 matrix of value and volatility, horses are your high value, low volatility product, right? So in this case, we can touch the stat forecasting. We don't need to interact too much with the system. It can be pull driven, and we have to just manage the parameters. Then I have my Mad Bulls, which are high value, high volatility products, on which statistical will not give me a good forecast accuracy, and eventually my inventory will suffer, right? So here I can manage my Mad Bulls in the product portfolio with pull strategy, but with a higher days of cover, right? And then you have the low value, low volatility turtles that are your slow movers. And then low value, high volatility rabbits that basically have intermittent demand and sell every now and then. But when they sell, they sell in high quantities, right? So it is very important to understand what is the makeup of my inventory on hand: horses, rabbits, or Mad Bulls or turtles. And when we do this exercise with some of the businesses, you'll be surprised to know that the rabbits, they are higher percentage of SKUs, high share of excess and obsolete, high share of slow moving inventory, but very little share of business. Whereas horses, when we look at horses, it has high share of business, less number of SKUs, less share of excess and obsoletes, and relatively speaking, less share of the inventory. So having an understanding of your current inventory makeup and splitting it into different product classes around value and volatility allows you to set up differentiated supply chain strategies. Now, what do we mean by that? So let's say I have my ABC and XYZ. And here it is only for illustration purposes. There is no logic or rationale behind it. So I can say that for my AX product, highly value, low volatility, I'll manage my business with 4 weeks of cover. And my high value, high volatility products, I can have 8 weeks of cover, my AZ, right? What happens is most of the businesses, when they do their inventory policy, they say, okay, for all A products, I'll have 8 weeks of cover or 6 weeks of cover. So here you can see immediately the fact that you are reducing 2 weeks on AX. You are basically optimizing the inventory without taking any risk on your business, because your inventory policy on ABCXYZ is then linked or drives your replenishment frequency. If it is an AX product, I can have a higher replenishment frequency versus my BX or my CX. And also I can have a different replenishment frequency for my AZ versus BZ versus CZ, right? So this is the next step that leads to inventory optimization if we have the clear understanding of our ABCXYZ or the makeup of our inventory holding. Now, you can slice and dice if you are a multi-category business, or you are a business where you have men's range, women's range, kids range, or unisex range. You can slice and dice this strategy into as many granular levels as you can. So for example, AX for everything except, let's say, men's category is 3 weeks or 4 weeks, but for men's category, it is 6 weeks. It can be due to XYZ reason, right? So you can slice and dice this strategy into different dimensions, multi-category, gender, product life cycle. You can have a different strategy for newness and end of life. We discussed about value and volatility. You can also bring in volume or order lines. You can also bring in margin as a component, long lead time, short lead time, or strategic and niche products that you want to manage as exceptions. So this basically becomes the second step after doing ABC XYZ, is to have a clear, dedicated, differentiated inventory strategy so that you can basically optimize your inventory and not have a one-size-fits-all approach that will only lead to allocating extra cash inventory, which you don't need. Yeah. Next one is linking the inventory or the safety stock with customer service level. So to give an example on this one, let's say we are talking about a grocery retailer that is selling thousands of SKUs, and one of those SKUs is oat milk. And the service level that this retailer wants to provide to its customer is 95%, which means if 100 customers, they come to the aisle to pick oat milk, 95 are satisfied and they are okay in disappointing 5 customers with out of stock. So that is the notion of 95%. And the average demand is 250 units. The standard deviation is 85 units. Lead time is 9 days. And then the standard deviation of lead time is 5 days, because sometimes the supplier delivers in 4 days, and sometimes delivers in, let's say, 14 days. And the target customer service level, as we said, is 95%. Now, what happens is a lot of businesses, they say that, okay, our target service level is 95%, but then they don't link that service level with inventory. How much inventory I need to carry to satisfy that supply chain objective or business objective of 95% fill rate, OTIF, service level, whatever metric you measure for availability. And there is a very easy way to do it. You don't need a sophisticated solution. You can even do it in Excel. That when we calculate the safety stock of any item or item location combination, is to have clear understanding of what inventory I need to carry to satisfy that fill rate of 95%. So the first step, as you can see here, is to calculate the standard deviation of demand during the lead time. Then have a clear understanding of what is the safety stock I need during that standard deviation of lead time, the sigma L, here you can see. And then you can take some extra buffer for demand uncertainty in case you want, which is what we call standard deviation factor. And then when this value of sigma L, service level standard deviation factor, is added together or multiplied and then added together, you have the new reorder point that contains the cycle stock and safety stock that is linked with expected CSL. Now the question here is, and this is an open question, how many businesses they link their inventory on hand with the supply chain, with the service targets they have. And if the supply chain professionals or communities or teams in these businesses, they have the tools or the skills needed to calculate the safety stock, that basically supports the business, right? Most of the time, again, here as well, we have a one-size-fits-all approach. Lead time is 9 days, and let's take safety stock of 5 days on top of it. So it's a very non-scientific way of calculating safety stock. And then in the end, we have to explain, in case we have low inventory or out of stock, why it is the case, or if we have excess stock, why it is the case. Which means if we have a proper understanding of inventory optimization techniques, we can be more proactive and value adding than reactive and trying to justify why we are out of stock or why we have excess stock. The third one, which is also very important for inventory optimization, is to have clear understanding of lead time deviation. So you may have with your suppliers SLAs where you fix the lead times so that you can calculate your OTIFs. So if the SLA is lead time of 10 days, how many order lines they were delivered on time, which is 10 days, early, which is less than 10 days, and later, which is basically greater than 10 days. Now, lead time deviation is very important, and it is important to measure the deviation of your actual lead time from your SLA, because it has a direct impact on your availability and inventory. If your SLA with your supplier is 10 days, but that supplier is consistently delivering you in 7 days, then you are basically carrying 3 days of extra inventory. And in some of the businesses, low margin businesses in grocery retail or hypermarket, supermarket, 3 days of inventory can be a big amount or big capital allocated to inventory. We discussed about the understanding the inventory cost structure. So one of the other inventory optimization techniques is having the understanding of EOQ. Now, with the reorder point, when we validate the reorder point, we know what the safety stock of an item should be, what the cycle stock of an item should be, when should we trigger the replenishment. But we don't know what quantity should be reordered once the order point has been triggered, right? And this is where EOQ comes in. And again, no rocket science, something that can be managed in Excel, and we don't need a sophisticated solution if we have the information or understanding of inventory cost structure. And the graph here basically says that every product, based on its demand and supply characteristics, has an optimal cost of or economic order quantity. Because if you increase your order quantity and your ordering cost may go down because you may order for longer period of sales. And if you increase the order quantity, then your carrying cost may increase. So we have to find the right balance between the ordering cost and carrying cost so that we can have clear understanding of EOQs. And in most cases, businesses, they don't have EOQ per SKU level because it is something that is not the teams are not aware of, and they are not aware of the impact that it has on your inventory holding. So very quickly, 4 techniques that you can use with very limited effort that can have a big impact on the way you manage your inventory, and it can directly either reduce your inventory or optimize your inventory so that you have inventory on the right product mix and at the right locations. And I'll recap it. So product segmentation, having clear understanding of what my value drivers are, what my volatility drivers are, and then have a differentiated inventory strategy per category of the product. Having clear understanding of how my service level and inventory levels are linked. And if I have a service level on A class of 97%, what is the inventory that I need to deliver that service level? Lead time deviation, have clear understanding of my early, late, and on-time deliveries and what the impact of lead time deviation is on my inventory, and then EOQ. Now, why it is important? Because everything that an organization is doing to achieve its strategic objectives, tactical objectives, operational objectives is linked to the quality of your planning and the quality of your inventory. So customer experience, let's say you go to a Zara store and you don't find the product that you're looking for. It's not available. It kind of impacts the customer service. You're not happy, right? Assortment, you go to a store, again, to find the product that you want, or a shampoo that you want, or a cream that you want, it is not there. So your assortment mix is also linked directly with availability and inventory. Of course, the way you manage your NPI, the new product introduction, your baseline, your promo, your end of life is directly linked with inventory. If end of life is not properly managed, we are in most cases stuck with the excess stocks. If NPI, we have a tendency of doing, we have a negative bias in the organization, we consistently under forecast our NPI, it results into lost sales. COGS are directly impacted by inventory related decisions. How to move the product inbound and outbound, and network balancing. So it is linked with the inventory. How you size your warehouses are linked with the inventory. And of course, we discussed in the early part of the presentation, profit and your financial performance is directly linked with how you manage your inventory as an organization. And I think a lot of businesses, they still consider, and it is unfortunate, but they still consider a supply chain as a cost center. But supply chain can be a value adding driver to the business if we can clearly get a handle on how we can increase the net income by providing availability, and also have a better return on capital, or have a better ROA by optimizing the inventory at the same time. Right. And in the context where disruptions are the new normal, right? Inflation is out of hand. We have energy crisis, and the war in Ukraine is kind of creating a lot of disruptions in the supply chains all over the world. And at the same time, there are structural changes where great resignation, metaverse, and other disrupting technologies, circularity and sustainability. So these changes, they are basically going to force the businesses to redesign or rethink their supply chain. But there is one constant, in spite of all the disruptions that are happening around us, and that constant is how you manage your inventory to basically drive your customer experience agenda, to have availability to basically contribute to your top line, and how do you manage basically your costs in related to managing the inventory to drive your bottom line. Yeah, I think that's it from my side, and I'll hand this mic back to Hamad.
Thank you very much. Thank you very much, Sandeep. Amazing presentation.
By the way, can I just, before we open to Q&A, I just want to take a minute
Sure.
and present something, right? It will not take more. So what I was trying to show, as you can see, Sandeep was showing the safety stuff from and he said you can do it in Excel. And if you go to SCMDOJO and go to best practices, you will see our inventory optimization tool, which almost can do everything what Sandeep has mentioned in terms of the optimization factors. We can do what is your current inventory, what should be your plant safety stock, inventory turns, stock days. In fact, our tool can also recommend that what is your current made to order or made to stock item, and what should be the stocking policy for that, right? And we also do the safety stock calculation. We'll tell you what is how much excess inventory, obsolete inventory, where you need to focus on, so on and so forth. I mean, if you go to this page, I'll share in the chat box, have a look, watch this video, right? So clearly is not as sexy as Slimstock, which cost a few $100,000, of course. But if somebody's looking for a cheap and cheerful solution, I think that would do the job, right? I just wanted to mention that in addition to what Sandeep has presented. Fantastic presentation as always. So over to Q&A and Sandeep.
Thank you very much, Mudassir, for this. I've shared the link of this tool, as well as those who do not follow still SCMDOJO. We are a growing community of over 4,000 global supply chain professionals on LinkedIn. Please follow the page and participate in those discussions. So what are we going to do now? There is an exciting opportunity for all of us to know more about who we are, because this is, as you have seen already, people are joining in from all over the world. Let's get to know each other. I'm breaking you into 6 rooms, and we'll have about 5 minutes. So introduce each other. If you have one question for Sandeep, please come back with that question in 5 minutes. This is your opportunity to know someone you do not know. The rooms are open now. Join in the room. You have 5 minutes. All right. Welcome back. Welcome back. Did you enjoy it? Did you find one new friend in supply chain in your room? Yes, no?
I think I found 3.
You found 3. Yeah. This is so this is what we are doing. We are practicing it every time we have a session. We provide this opportunity, 5 minutes to network and know at least one more person, because our network is our network. We never know what kind of opportunities will come in our way, or we may need to take some help from someone. So this is what SCMDOJO has been doing. Yeah, some found 4. So this is amazing. So we have 5 minutes approximately. We can probably take 2 questions from the group. If you have any questions for Sandeep predominantly or for Mudassir as well, we'll take these 2 questions. Sandeep can respond, and if you have more questions, you can always go to our page SCM Dojo on LinkedIn. I shared the link already. Please post your questions. Interact with people out there. 4,000 community of 4,000 global supply chain experts are sitting there to help you. So we'll take our first question. If you have any, you can turn on your microphone, or you can.
Hi, Habad. This is
Yes.
Sayed Madmisam speaking. Do you
Yes,
hear
please.
me?
Yes, please go ahead.
One small question that always teased me when handling the inventory. This is with Sandeep. There is a difference between inventory carrying cost and inventory holding cost. So briefly, if Sandeep can explain me what is the difference in these two terminologies.
Inventory carrying cost is uniquely linked to your storage, warehousing, how long it stays in the storage, how basically you move the products around. Whereas inventory holding cost is the total, all the different components of the cost structure.
Superb. Next question we have from Seth Balba. How to measure LT variation considering current environment? Yeah, well, I think very good question. In the current environment, it is practically next to impossible, but it is more when you have stable flows where SLAs are possible to be followed, then you can do it. But even pre-COVID, I think there were not many businesses who were doing lead time deviation as an analysis. So that still remains an opportunity. And if you are, let's say, a regional business or a national business that is not that much impacted by the flows, then it is still possible to do lead time variation analysis. Super. Any more questions? If not, then I'll ask Mudassir to share some. As we always say, parting thoughts. Yes.
This
Yes,
is Sandesh.
Yes.
Actually, I'm from the agriculture background. So, like currently, I'm working in the Dhyat, which is a agri-tech company in India. So, seasonality is the major factor in the agriculture. So, how the seasonality will impact on the inventory, or how we can manage based on seasonality, because seasonality is a key factor of agriculture.
So I think seasonality is basically your anticipation stock that we discussed. So a lot of businesses that are impacted by seasonality, you have to anticipate the stock. So I spent 15 years in cosmetics industry. And then you have a lot of seasonality in cosmetics industry as well. For example, sun care products, you only sell from April till June. And you don't sell them for the rest of the year, at least in the Northern Hemisphere. And if you are in Southern Hemisphere, you sell them from October till December. The way to manage the seasonality that is purely related to seasons is through anticipating and then having a kind of peak strategy and building the inventory as you go along. Now, there can be seasonality that is event driven as well. So you may have solar events like Christmas and lunar events like Chinese New Year and Ramadan, where in case of lunar events, the seasonality moves. And that it is the same strategy to manage event related seasonality. It's to anticipate. All right,
okay, thank
super. We have one more question, which will technically be the last question from Trevor. He is asking, what would be a good rate to calculate capital carrying cost? 8.5%, for example. So he's just asking what would be a good rate.
I think it depends from one industry to another. Because different verticals, they have different constraints. So if you are in pharma or automotive or food and beverage or luxury cosmetics, depends which vertical you are in. There is the industry standards are different.
All right. Thank you very much. Thanks, Sandeep, for for such an enlightening presentation and responding to these questions. Thank you everyone for joining in. Mudassir, your parting thoughts.
No, I just want to say, I want to answer, I think Mr. said, he says safety stock calculation. So I shared the blog and we have a tool. I mean, tool does it as well. I just want to say a special thank you, Sandeep, because I know how busy Sandeep is, right? I mean, he's a vice president for the business transformation, super busy guy, a lot of knowledgeable knowledge. So I just want to say super thank you for Sandeep for finding time. And this video, the content, what Sandeep has presented is proprietary content, and unfortunately, we won't be able to make this presentation available. I like to think so. However, the presentation, as we said, is recorded into this video, and this video will be available in 1 to 2 weeks' time on SCMDOJO channel. So if you want watch the video, and I'm sure Sandeep won't have a problem with that. With this, again, we will continue with our monthly session. Hopefully, Sandeep has made some friends. And if your businesses are looking for a super good inventory optimization, demand forecasting SNOP tool, and I would recommend Slimstock. So if you are in that case, contact Sandeep, contact anybody in Slimstock, and they are one of the top team, especially in Middle East and Africa, very dynamic team. I know all of them very closely as well. So I would recommend to check out Slimstock as well. So with that said, I'll see you in our next webinar, which is on 8th of January. It will be on basically strategic transformation of procurement function with one more expert, which will be, I think I will reveal it pretty soon. So subscribe to our newsletter, and you will see who will be coming. Is somebody who's very senior. He was actually chief procurement officer for Emirates NBD Bank. So very important person coming on the 8th. Dr. Arafat, let me tell you the name as well. We will be talking about strategic transformation. So another high-class executive coming and helping us out and training us out. Thank you very much. I know Hamad bhai, you need to go. Thank you.
Yeah, I'll just quickly finish it with thanking myself. Sandeep. At least I've got one more person and a few others as well, but I could only see Sandeep here. And please join in next webinars, because this is amazing opportunity to keep learning and keep engaging and keep networking with the community across the globe. Recommend SCMDOJO's page to everyone in your network. Let's keep growing, because if we don't grow, we don't go, which means we will not be successful. Thank you very much. All the best. And hopefully the video will be available in 2 weeks. Bye for now.
Thank you.
Thank you.